right, so I'm going to get started. I just have a couple words of introduction. So first off, good afternoon, everyone, and thank you for joining today's fintech discussion on the expansion of digital currency. My name is Farah Narkowitz. I am the Marketing and Events Manager for the Stephen D. Cutler Center for Investments in Finance at Babson College. Today's event is not only for the Babson community, but also for the public as well. So for those who do not know who we are, the Cutler Center enhances Babson's innovative and practical approach to finance education through programs and resources that enrich the student learning experience, support faculty research, and engage our alumni community. So before we begin, I just want to make quick mention that we are going to be recording this session and we will be sharing it on our YouTube page. Also, please feel free to utilize the chat button and submit any questions that you might have, and we'll get to those towards the end of the hour. So in the interest of time, we'll get started. So first off, I want to take a moment to introduce our moderator for today. And so please welcome Damanick Dantes. Damanick operates Dantes Outlook, which specializes in global macro and commodities and applies his macro knowledge to manage equity and fixed income portfolios. He is also a crypto market analyst at CoinDesk, where he writes the daily market wrap and provides technical analysis. Previously, Damanick was tasked with curating timely research and expressing global asset allocation views for portfolio managers at Fidelity Investments. He earned a Bachelor of Science in Economics and Finance from Babson College and is a Chartered Market Technician designation holder and member of the CMT Association. So thank you very much for being here, Damanick, very excited. And then I also want to take a minute and introduce our guest speaker for this afternoon, Nicole Olson. Nicole is Vice President at State Street Digital. Nicole is an experienced financial markets innovator focused on the intersection of institutional finance and new technology. During her 20 years in fintech, Nicole has created bold new marketplaces for equities, corporate bonds, and capital markets. In her current role with State Street Digital, Nicole is focused on the new era of innovation in financial markets, specifically blockchain and digital ledger technology. She is responsible for charting the digital asset strategy and leading teams to build digital asset products and services. Prior to her role at State Street, Nicole co-founded Electronify, which was an electronic corporate bond marketplace, and served as the firm's chief strategy officer. Nicole worked previously at Liquidnet, where she launched the equity capital markets business, established and managed strategic partnerships, rolled out new global markets, and built the company's investor relations program. She also has experience in seed stage fintech venture capital. So Damanick and Nicole, I'm going to pass it over to you to get this conversation started. And again, to all of our guests, please feel free to submit questions through the chat, and we'll save those towards the end of the program, probably around 1:15.
Great. Thanks so much, Farah. It's a pleasure to be here. And hello, Nicole. Great to see you again.
Hi, Damanick. Thanks so much. It's great to see you. And thanks, Farah. And thanks to Babson. Really appreciate the opportunity.
Yeah, so this will be an exciting panel. I just broke up the session into three subsections. So one will be focusing on the need, the demand side, and then two, the solutions that you're providing at State Street, and then three, the scalability, some of the barriers and also opportunities for growth. So just starting off with the need, and in entrepreneurial fashion at Babson, we always talk about market research, right? And figuring out what the actual consumer needs. Given your experience in capital markets, what were some of the key pain points in transacting in the private markets from both the buy side and the sell side?
I think pain points is exactly the place to start this conversation. And that's really the starting point for our group as well, is from an institutional perspective at State Street Digital. So we're looking after how do we deploy DLT technology to solve problems, to make processes more efficient, to enable access to assets that our clients otherwise would not be able to access. So that's really our focus. The pain points are, if I had to categorize, I would say they would land into a few different buckets. So the first pain point is lack of efficiency, and that's a big one. So this can mean a lot of things, but as we all know, I think in institutional capital markets, there are a significant number of players typically that handle any one transaction, right? So even if you think of like the trading of an equity, for example, let's just follow that through. So that equity unit has been custodied by a party. There has been research that has gone into the understanding or the thesis of that trade. Then there's the whole execution of the trade, the reporting of the trade, the settlement, and then the post-trade digesting of that transaction. So a lot of parties handle one transaction, and that's just a simple equity transaction. So one of the pain points is, how might we apply DLT and blockchain tech to make that more efficient? Can we bring, for example, parties together in one place so that we don't have disparate data sets, so that all participants are working off of the same data set? And in doing so, we're eliminating what we call recons in that process. So the recon happens when there's a disagreement between two data sets, and that has to be mediated and solved for. And so if we can just simply get all participants to use the same data set, that greatly solves an inefficiency problem. So that's an example of one. The other issue, the other pain point that we see is risk. So because of changes in legislation, banks like State Street and clients are limited in terms of risk exposure that they can have to themselves in terms of trading, and to their counterparties. And so one of the interesting applications of blockchain tech is, how might we apply blockchain to solve for that consumption of risk? If risk in our world is a consumable good. And so if we can utilize blockchain technology to, for example, close down risk exposure more efficiently and more quickly, that opens up the ability for more transactions, for counterparties to reduce risk as they face one another. So I would say, I'll start there, Damanick, and then stop talking for a minute. But I would say it's really those, it's efficiency and risk are two of the big themes.
And how do you define risk? Is it counterparty risk, asset price risk? What are we talking about?
Yeah, so I think counterparty is a big one. That's probably the most significant. There's also something that we talk about that's jump risk. So in capital markets, right, if the value of that asset jumps in a point in time, so to give a practical example, let's say there's a trade and that trade is collateralized, and that collateral, the value of that collateral shifts while that trade is still open. That means at that point in time, that trade is no longer fully collateralized. So there's that jump risk element that we would categorize as well. So I think those are the two largest headings, counterparty risk being the most significant.
Got it. And then there's also the need for liquidity, right? So where's that capital, right? We're talking about private markets. I saw you had a survey of asset managers, I think around last year. It showed a lot of their asset management is locked up in public markets, right? Where there is liquidity. Where do you see that money moving into the private markets, and how does tokenization kind of unlock that opportunity for alpha?
The search for alpha is absolutely the name of the game for asset managers from our perspective. And so that's been driving the shift to private markets as companies are staying private much longer. By the time a company does go through an IPO, that hockey stick moment of growth is typically over, or maybe not entirely over, but as an investor, you've really missed that significant upswing that can happen in the beginning. So how do we enable institutions to access that? Well, certainly there are some clients who absolutely can. These are alternative investors and hedge funds. But then you have this huge swath of clients that represent, individual investors. and who, because of liquidity constraints, cannot broadly invest in these private assets. So a liquidity constraint is, the institution would have to be able to sell those assets under a certain time frame. And for private markets, we just don't have there's zero pre-trade transparency, meaning it's very difficult to find and value these assets. There's not a ready order book like there is for public equities, right? Where at any point in time, we can just hop on and understand the current value of that asset. So for private assets, that does not exist. There's data that we believe at State Street that can really be added to support the valuation of these assets. So how does blockchain come into play for private assets? Well, one of the areas that we're focusing on is looking at real estate and real estate transactions. And so if we were to enable more frequent valuation of these real estate assets through the use of novel data. So, if we're looking at things like commercial real estate, and you could almost build an algorithm to value that asset based on comparable buildings in the area, based on even novel data points such as foot traffic in Midtown Manhattan around the building. So an algorithm that would value that asset on a more regular basis. Those data points can be minted into a coin to support the valuation of that asset. So wherever it travels, that data will travel with it. And therefore providing the information that we might need to be able to value that asset, to be able to therefore trade it more efficiently. And if that recipe happens, then that leads to liquidity. So if we can bring more liquidity to these assets, then these mutual funds, for example, might be more able to invest in these assets for an individual investor.
Got it. And have you heard about any concern regarding making these assets more tradable, because they are long-term in nature, right? We don't really value them as frequent as we do with public equities. Typically, when you have a liquidity event, everyone goes to appraise the asset. Why is there a need now for a more real-time valuation as opposed to having a long-term asset where it is valued when there is a liquidity event?
Mm-hmm. Well, I think it's demand driven. I think that in the market today, there is a significant focus on these private assets just because it is a growing asset class. The alpha, as I mentioned, is no longer, fully realizable in the public marketplace. So the focus is, okay, how do we bring additional liquidity to this marketplace so that more participants are actually able to trade it? So to gain access, there's a primary issuance consideration, and then there's the secondary trading consideration, which I think you're getting to now. And yeah, the data story that we laid out, it really supports a robust secondary market for some of these assets, assuming that they can be valued, right? Assuming that we have that research to value them, then we get robust secondary trading and a complete shift in the liquidity profile of those assets.
All right. And then based on these pain points, how did State Street Digital come about? Talk to us about your journey with, getting stakeholders involved. Is there any pushback, any type of, bright moments that you saw?
Yes, so I've been a part of State Street Digital for almost 4 years. And when our group started, and when I was brought over, it was a small group, and we were organized in more of an innovation arm of the bank. The mindset then was more, let's experiment, let's talk to our clients and understand what sort of POCs or proofs of concepts would they be the most interested in experimenting on with us. So that was the mindset back then. That has completely shifted. And I would say catalyzed by the appreciation in Bitcoin and Ethereum. So we have crypto to thank for increased interest in blockchain technology for sure. So there was an absolute shift change about a year ago when institutions, suddenly the phone lines started coming the other direction and our clients were calling us saying, State Street, we need help. We need to understand what's going on with digital assets. What should we be thinking about? How do we lay down technology plans, et cetera? And so thus began State Street Digital. Nadine Shakar, who was heading up global markets at the time, recognized the real opportunity and the future for State Street. And that future is really in these new technologies as we look to support clients in their journey from, traditional assets to what we think will be increasingly a digitized world. So the unit was formed last summer. We've added to the group. The mindset has shifted from then this POC world to, okay, now we're building services. We are engaging with regulators on approvals for these services. We're rolling them out. We're looking to scale them. So it's really shifted from innovation to the future vision for the bank.
Nice. And then I also saw your survey showed a lot of the asset managers, they think blockchain is the key to real-time settlement. Without getting too technological, how does that work with the distributed ledger technology?
So as blockchain is deployed, and there's, if you think of the spectrum or sort of the flow of an asset, we think all of those pieces will eventually come on chain, but it's not going to happen at one time. And so in terms of the settlement, kind of that one of the last steps in the process, so the holy grail is T+0, right? Is like I can trade today and it settles today. So how do we make that happen? Well, the asset needs to be tokenized, right? In some form along the way. And then we need to have a digital instrument or a cash equivalent to facilitate that T+0 settlement. So State Street has invested in Finality, along with 14 other participants on the street. Finality is this digital settlement asset. So, in lieu of the United States having a digital dollar, US, a central bank digital currency, Finality and that instrument is what we're looking to utilize. And then whatever rails we lay down, we do anticipate that the instruments used in settlement will become more and more diverse.
Is that like a stable coin of sorts, or is it something totally different?
Yeah, it's a stable coin. It's a central bank digital currency. I think in that case, what we're looking for is stability and a very volatility that is minimized as much as possible. So something like that. That's right.
Very interesting. And then also a majority of asset managers want to own the digital asset, right? So talk to us about your custody first model and how you're tackling that.
So, State Street's bread and butter is custody. And that was important to me in terms of my decision to join State Street. I knew I wanted to get engaged in this digital asset journey. And as I was looking on where to go, I landed on custody because the custody and the control or the safekeeping of that asset, especially when it's a crypto asset and it's a bearer instrument, is the official sort of book and record of that asset and of where that asset is is currently owned and then controls where that asset can move within the ecosystem. And so I think custody makes a lot of sense. Custody was and is our top priority in terms of launching a new offering to our clients this year. We've announced a partnership with Copper to do that, to build that. And so it really is leading with custody because that's where the asset resides, that's where it lives, that's where we can deploy it in other ways for our clients. So that's the reason that we're really focused on custody first.
And there's some regulatory things, right, regarding that, like eligibility, reference pricing. Can you get into that a little bit?
So, in all of these models, the regulatory landscape in the US is developing. There are some significant considerations that State Street has, and our MO is to build a comprehensive plan. It is, as one might imagine, from a risk perspective, very robust. And then we go to our regulators and vet and kick the tires and make sure that the solution is ironclad and meets the regulatory obligations. So that's where we are in terms of our viewpoint of rolling out custody in the current regulatory landscape. Nice.
And then you're known for custody, right? You got 43 million under management, right? Or under custody. And are you partnering with startups, or what's the competition like? How are you innovating and constantly staying ahead?
Yeah, so I think it may be trillion, but
yeah, trillion. Sorry, way off.
Partnering with startups is key. So I came from I've had in my career experience working at startup organizations, and the innovation in this space could not happen at this pace without a step-by-step partnership between the startups and the larger legacy institutions. And this is why I think the beauty of working or being a startup is that you can move quickly. You can dream, you can get funded today, with relative ease, especially in this space. And those products are really, and services are cutting edge. State Street is a much larger institution with a very robust risk framework and regulatory framework, et cetera. But what State Street has is the trust, right? The distribution, the relationships, the critical mass of participants in our network, if you will. So when you bring those two things together, I think that's where you create real and sustained change in the industry, is that those leading edge ideas that then are adapted to an institutional audience and then rolled out at scale. And I think we both need each other. So, State Street has made several investments or acquisitions in the space. And then we work with partners on a more informal level every day. And those are very valuable relationships.
Nice. And then a lot of crypto enthusiasts, right? They pride themselves in distributed, open source blockchains. Would this blockchain be more closed-end, enterprise only, or would this be an open blockchain?
So State Street realizes that having the breadth of institutions globally that are State Street clients, we understand that our role as custodian to be at the center and custodying these assets, servicing these assets, we need to speak all of the blockchain languages. So we are prioritizing in terms of where to start. We've also have made an investment in a technology company that has a patent on building bridges to disparate blockchains. So how do we bridge and ingest that information into State Street systems more efficiently? So in terms of public versus private, I think there's the best of both worlds. And I think open source technology, the robustness of that, the ecosystem that is built up around that technology is extremely important to adoption, to understanding which technologies will survive and will really win, if you will, in this era of fragmentation. I think open source is extremely important. We need to balance the technology that we use with also some layer of control that will meet some regulatory obligations, that will meet privacy requirements, those kinds of considerations. So, there's a sweet spot in the middle there where I think it's the open source technology layered with some of those additional controls that will lend itself to uptake from an institutional audience.
Got it. And there's also the barrier in moving into scalability of education, right? I saw the survey as well. Most don't have an expert knowledge of digital finance. How are you sort of bridging that gap?
Yes, we're building our teams. So there was a period where I think my colleagues and I were on, it was a grassroots effort. It was a one-to-one effort of calls with our clients to, really see that sort of educational layer, to understand what they were interested in, spend a lot of time with them. We've since built a sales team and a sales boot camp. And so we're scaling that capability. And I think that it has shifted significantly. The knowledge base has shifted significantly in the past few years. So, whereas the initial questions were, what is a blockchain and what's a smart contract? And now the questions are very sophisticated, around different blockchains and a level of knowledge, and I think of that hints to real interest and real plans at an institutional level. So it has shifted in a short period of time.
Nice. And then one of the interesting use cases, other than real estate and smart contracts and all of that, was tokenizing collateral. I thought that was pretty cool. Can you walk us through how that works and what are the possibilities around that?
Yes, so we ran a pilot with one of our clients late last year. And the problem that we realized was that for a specific instrument, so we're looking at a foreign exchange forward contract and the inefficiencies in that process. And how might we resolve those inefficiencies and also then more appropriately collateralize those trades using blockchain technology? So the pain points that we touched on earlier, Damanick, are exactly what we hit on here, right? So there was this inefficiency. We realized that there were a significant number of these trades that were resulting in recons. So what we did is we used a blockchain and smart contracts to automate the mark-to-market calculation and valuation of those contracts on an intraday basis. And we had all the parties on blockchain utilizing that same data set, right? One data source. And once those contracts were valued, we could then understand the variation margin or the assets that needed to be posted as collateral. And so once we understood that, the next step is, okay, how do we fulfill that variation margin? And remember that spectrum that I mentioned, right, where not everything is going to come onto the blockchain at once, but what are the pieces that we'll start with? So we haven't yet actually tokenized collateral. We're working on that. We haven't yet done that. But we, in this pilot, utilize something called a memo pledge as a proxy for tokenization. So the memo pledge enabled us to, without that additional settlement time, to fulfill that variation margin. So what we could do is value that contract, understand the variation margin, and then quickly fulfill that variation margin. So we close the gap on that open position. We reduce that jump risk. We reduce that counterparty risk. And now we're looking to scale that.
Got it. And the variation margin, is that the difference between assessed value and real value? Or
So the variation margin would be when the collateral when the trade is initially put up. There's a potential collateral requirement. Then the currencies fluctuate. One party is in or out of the money. The party out of the money needs to top up, right? So that variation margin is what is required to top up to make sure that that trade is fully collateralized.
interesting. Okay. And then if there is a possibility that risk is increasing, does the other party, like, do you automatically transfer ownership? How does that work in terms of a call or something like that?
Yeah, so the memo pledge enables the immediate fulfillment. So the counterparties have to have signed up for the ability to memo pledge at State Street. They have to be custody clients, and then the memo pledge effectively, it's a line item. It shifts. It puts a hold on those assets effectively, so they can't be double spent, and commits those assets to fulfilling that collateral requirement.
Very cool. Okay. And then I also heard about like tokenizing invoices. Have you heard about that? Have you guys been piloting or looking into that specifically?
Tokenizing invoices?
Yeah, like for trade finance and whatnot.
Yeah, we're not directly involved in that, although I think that's a really interesting space. If you've got good information that, that invoice then becomes this asset that you can utilize in other ways. What do you think about that?
I thought it was pretty cool. I think it's like, it's something where you can value the supply chain, right? Everyone wants to get their receivables in quickly. So this is a good way to kind of, put together a contract and streamline your accounts receivables. I think it's pretty cool.
Yeah, and there's an element of risk
reduction
reduction there as well, right? So if you have, an automated process, like let's say there's a smart contract and you layer that on this receivable, and that it's going to get paid because you have visibility that the money is in the account. The payment for that accounts receivable is automated. We're getting into this risk discussion again. So now you've reduced the risk that receivable will not get paid, and now you've got this asset, right? This future, this receivable. So what might you do with that in the future that you weren't able to do with that in the past, in terms of utilizing that asset elsewhere? Could you sell that receivable, etc.?
Yeah.
So yeah, I think that's a very interesting space. We do have corporate clients who I think have mentioned that, but it hasn't come up as part of the regular dialogue that we have with our institutional clients, which is really the bulk of the clients that State Street has.
Nice. And then moving into the regulatory hurdles, which is a lot, right? I would imagine.
Yeah.
What's that discussion like? And are we moving the needle in any way?
Yeah. So it's a mosaic. It's currently, jurisdiction by jurisdiction. So we're seeing some bright lines starting to pop up, and we're focusing on those geographic areas. So I can give you an example. One is in Germany. There's a law that there are three laws as part of it. I won't get into those details, but they're very far along in terms of passing legislation around this ability for what they call a crypto registrar to be on the blockchain, to be the official books and records for like a mutual fund, for example. So with that clarity in Germany, I mean, it's a boon for that market, because now if these fund managers want to issue tokenized fund, where they have, where do they go? They go where they have clarity. And so, Germany is already a significant player, but my guess is that if they're a first mover and they have that regulatory clarity, that it'll be a boon for Germany in terms of the issuances that occur there. So there, that's just one example of clarity in a market, and Damanick, we spoke about this White House executive order that came out, was it last week before, right?
Yeah.
Yeah. So that intention and that focus on legislation and bringing a multi-agency approach to digital assets into crypto, is a positive, because I think with clarity comes more adoption, particularly on an institutional level in the United States. So as these viewpoints mature, as we have more clarity, I think we start to then reach kind of a fusing of this mosaic that we have right now, which is really quite jurisdictional and in development.
Got it. And there's also been some pushback regarding deal quality, right? I know I've spoken to a lot of the other platforms and transfer agents who said everyone's flushing to the blockchain just because they can access new investors without any concern for the quality of the deals. How do you sort of ensure that investors are, doing their due diligence and not just looking at it from blockchain hype, but looking at it actual from the quality of the deal?
Inherent to anything that we would serve up to institutions, it would have to pass muster. So just because the issuance is tokenized and it is on the blockchain, all of the current regulatory and due diligence obligations still exist. So if these are, not IPOs, but these are private offerings, so let's say they're Reg D offerings, all of those filings, all of that still has to take place in order for it to be a legitimate offering. And so the fact that it's then tokenized, becomes interesting and can add some interest to the offering itself. But from an institutional perspective, there's a slice of those offerings that are interesting, and they have to be of a certain size. And there is a supply in the private markets for these large private offerings that would be institutional grade, if you will, and that would be our focus. So speaking on the other end of the spectrum, I think that's probably the first area that we've seen the regulators start to crack down on that. These offerings are, if it looks like a security offering, it probably is a security offering. I think that we've established that these ICOs, particularly over the past, that have gone awry, those are security offerings and should be treated as such. So, I hope that my hope for the market is that as this becomes more and more institutionalized, these sort of edge cases that we hear a lot about become really just that, just edge cases, and they don't sort of weigh down the conversation on what this technology can do. I think we've moved past that, but we definitely have seen that in the past.
I agree.
I think you do.
Kind of removing the Wild West scenario by bringing everything into the existing framework.
Yeah.
We've got securities, we've got a framework around that to protect investors. And the only way to do that is institutionalizing it, right? Moving from the 2018 ICO craze, which was unregulated, right? And just crazy, to now we have the infrastructure and the transparency that allows investors to do their own due diligence in real time, right?
Yep, absolutely. And so if the win here is additional data, an expansion of the asset class, of the investable asset class, transparency, autonomy for the more direct relationship for the individual investor, I think that's the win. But I agree with you. I mean, a few years ago, when I joined State Street, actually, we were in the middle of the this is it a security? Is it not a security conversation? And that definitely was a wet blanket for a little while. And I think at that point, Bitcoin was not a word that institutions were really looking upon with a lot of favor. There was a lot of, I think, risk associated with it, but we have definitely moved past that. So I agree with you that the framework exists. From a security standpoint in the United States, we need to use that.
And then before we move to questions, timeline. 2 years from now, you're back here and we're talking. What does it look like?
2 years from now, hopefully we're in person and we're
Yeah.
in an auditorium in Babson, on Babson campus somewhere. Okay, so what does it look like 2 years from now? I think 2 years from now, we've got much more adoption of the technology. So we've got the largest asset managers, hedge funds, endowment funds, et cetera. They are on a blockchain, or they have a node that they're running, or there's a hosted node, but they are engaged, right? That we move from exploration. I think where we are now is some deployment and research, and then the next phase is pure adoption, right? Like what the value prop is such that it's extremely compelling. The risk is reduced to a point where it becomes palatable and it becomes a choice that these institutions can make and feel certain that they're doing the right thing on behalf of the individual investor. They're an investor. And so I think in 2 years we get there. I think that we start to unlock real liquidity and open up some of these markets that are hampered right now by illiquidity. So I think watch the private market space, absolutely. It's a confluence of demand with the pain point, with the appetite to solve it. So I think that's going to be a very interesting spot to watch with real adoption. And then, then there's the pipes, right? That the moving forward of the ability to build this foundational tech inside these large firms so that more of those processes are on the blockchain. And so then we get to this point where adding additional products and services or asset types is much easier. It's much more like flipping a switch, as opposed to how do we get regulatory approval? How do we build this piece from scratch? How do we, and it's a fragmented story now. It becomes much more kind of straight through in terms of launching new products.
Awesome. And that's great for talent.
What do you think on that question, Damanick?
Yeah, I was going to say that's great for talent. We're going to have the new class of folks who understand digital finance and traditional. And that's the best way to do it. I think a lot of people come in it with one hat, and it just creates schisms, right? So hopefully, something will reach a middle ground. And I think the great thing is that we have choice, right? You've got the institutional client base, and this is just another avenue for them to add alpha and do their own assessment.
So with the one hat, can you say a little bit more about what you mean by that? People come in with sort of one hat, but then going forward, is your vision that develops as people have more experience in various areas? What do you think that looks like?
Yeah, it's either, people, I think from the crypto space come at like technology first, right? And they really can't speak the language of a sort of an asset manager. And then you have the other folks that come in it from the asset management lens, and that's pretty much all they knew. But they really can't blend the lines between crypto and the technology with the traditional world. But the folks who can sit on both sides, I think, have a competitive advantage, right? To understand both the need and the solution.
Absolutely. And again, and that happens, I think, your question about startups working with these larger entities, exactly. I mean, that's where that happens, right? Because people are moving back and forth. And I think you're absolutely right.
Yeah. Awesome. And then some questions.
Yes, we do have some questions, but I actually want to piggyback on this last section here. But since we do have some students on the call, just curious, for those who are interested in this digital asset space or working for a State Street Digital or another major institution that's going down this road, are there any specific skills or platforms that they should understand so that they are sort of coming to the table already at an advantage, so that they're understanding both sides of play?
Mm-hmm. All right, so maybe I'll start, Damanick, and then I bet you have thoughts on that too. So I think there are multiple entry points, and so one is tech, right? So it's an engineering standpoint. You're going to be the expert on the technology. The other entry point is an expert in some portion of that value chain in institutional finance, because what's not happening, we're bringing in blockchain technology, but we're applying it to an existing process. And so in order to, I think, really add value at your firm, you need to have a good understanding of that element in the value chain. So whether it's trading or custody or fund admin, to be an expert in an area, I think, is a requirement in order for one to understand how to bring in DLT to enhance that area. So I would say it's being an expert in one of those areas, and then eventually, I think, as your career progresses, you cross over. Damanick, what do you think about that?
Yeah, I agree. And then also just understanding the pipeline, right? Or the pipes, the plumbing between how these trade settlements work and things like that. That's always something I'm always interested in learning. And I think if you understand the nuances, it kind of just opens up the thinking, right? In terms of how can I make this better? Where is it broken?
Yeah.
And I think that's kind of a good starting point.
Yeah.
Awesome, thank you. So we do have a couple other questions, so I'll circle back to the discussion around the Biden administration, but the question came up in regards to regulations. What are your opinions about the recent presidential directive regarding digital currency? Is the US at risk of being left behind while other governments break the paradigm? And I sort of big picture, timetable wise, is the government sort of on the right timetable for dealing with this now? Are they behind schedule? Are they ahead of schedule?
Mm-hmm. So we addressed, I think maybe we spoke about that question a little bit already in terms of this mosaic regulatory approach. Great to see that the White House, the Biden administration is saying we need this sort of aggregate multi-agency approach. So I think that is definitely a positive. Part of that executive order, one of the main goals explicitly stated was maintaining, a very competitive position in the world stage of financial markets. So, clearly we have an eye on that. From a regulatory perspective, the key is always protecting the end investor, right? So to make sure that the end investor is not harmed, to make sure that the administration has the ability to still affect financial market what's the word I'm looking for? So the ability to affect currency supply, interest rates, right? And to still have control over what really drives a financial market system. So I think that clearly that's a key consideration as well. So is the US at risk of falling behind? I think that we will get it right. I think that it's been beneficial for us to see how some other jurisdictions have approached things. I think we're in early days, so I don't think that we are. I do not believe that we are late. I think we will get it right. I can also say I'm sure that people are anxious to see what where the government is going to really lay down some hard lines. That will be interesting. Damanick, what do you think?
I think, yeah, there's definitely benefits in being patient, right? You definitely want to get it right. And I know there is a risk of folks going offshore and doing that. But if the US maintains its stance of being the place where, things run efficiently and well, then I think investor protection is paramount, and we're kind of the beacon of that.
Yeah.
Hopefully.
Do either of you have any thoughts about any other countries that are doing this well that the US should sort of be following or trying to mirror for some best practices, I guess you'd call it?
That is a very good question. I'm sure that they're looking at these aspects that have aspects of legislation that have been decided in other countries, like this German regulation that I spoke about earlier, and looking at okay, is that where we start? Is this something that we should consider? So I would assume that it's an expansive approach in looking at what other countries are doing. I wouldn't necessarily say that there's one particular country that I would look at as a model necessarily.
Same, yeah. I know Canada is pretty, with the ETF thing, they're pretty first mover there. Brazil also has some interesting stuff going on in terms of blockchain. But again, you want to do it right. You want to make sure it's, protecting the investors and all of that. So I think everyone's moving quickly, hopefully.
Another question that came through, and I can direct this to either one of you. Do you have a view on the future of institutional adoption of crypto as an alternative asset class? What needs to occur before broader adoption will occur?
Mm-hmm. Well, Dominic, we could go to our survey here. So State Street conducted a survey with Oxford Economics and found out that 82, so that there were 300 institutional investor respondents. 82% were allowed to have exposure to crypto today. 81% expected to increase their allocation in 2 to 5 years. The concern, so looking at the barriers, Farah, to your question, cybersecurity is a top concern. So that clearly with custody is something that needs to be addressed to an adequate level of satisfaction. So I think that's a barrier of adoption, but it's good to see the ability to have exposure. I think we'd have to dig deeper to define exposure. Is that actual exposure to the underlying instrument? Is that exposure to an ETF that is invested in the underlying? I think we'd find some nuance there. So I think that it's only going to expand from where it is.
I would say we need some clarity on exchanges first. The spot exchanges, there's still a lot of regulatory pushback regarding spoofing and all of that. Yeah. A lot of institutions now, and I'm sure you can agree, Nicole, is that they go futures first, right? Their CME group is familiar, and they're doing it via the futures market. A lot of hedge funds also are doing a lot of that. So I think right now it's being handled as a speculative asset, right? The cryptocurrency world. And it is a risk asset. And I think folks are going to have to think about that in terms of the volatility in their portfolios. Yeah. It works great in a bull market, and in a bear market, you kind of just want to trade the volatility. And I think that's exactly what we hear from a lot of the hedge funds when we're reporting at CoinDesk. And that's currently how it is now.
And I think that, the volatility question is a great one. And then that goes hand in hand then with real liquidity. So if these institutions are getting more and more involved, are they buying and holding? What does that mean for the liquidity profile of I'm looking at, the top, right? The top few right now. What does that mean for the liquidity profile in terms of, smoothing out that volatility? More liquidity would help do that. So it's I think it's going to be an evolving story that is around liquidity, utility, and volatility. Absolutely. And I think it will shift how the instrument is viewed. Right now, what we're seeing is a high correlation with technology, with the technology sector, right? So significant correlation there. Will that continue? Will the asset, as the asset matures, will that shift? And then is it deployed for other reasons? I think it'll be interesting to watch.
I think it's also a reflection of how do you value it, right? If you've got cash flow, you've got a valuation model, I think that naturally allows volatility to kind of be suppressed. But when you don't have that, and it's just tokenized and it's utility, and people are just judging it based on transaction or speculation, you're going to have a lot of volatility, right?
And then, of course, we don't have right? There's no consolidated market, right? So you've got these disparate fragmented exchanges. How do you know what is real volume, what's not? What do you base the price on, right? That's the artistry that comes into all of this. That's important, and it's important for institutions.
Same thing with CoinDesk. It is tough getting good data.
Right. I can imagine.
So I do have one last question, where obviously cybersecurity and risk remain a primary concern for a lot of people. How do you manage or regulate, and I'm not sure what the right word is, so that digital assets, cryptocurrencies are not being used in nefarious ways, whether that's for money laundering, or if you look for the news right now, people are concerned that Russia is going to bypass sanctions by converting rubles into cryptocurrencies and stable coins. So how does that get handled?
So at State Street, it would be handled the same way that we handle it today, right? Which is with very robust AML and KYC controls. And so utilizing the existing framework in order to establish those processes. Now we have to layer in some new data providers, so that we can look at sort of the history of that asset that we wouldn't have to do for a more traditional asset. So there is some modification that would need to be made because of the specifics of how these assets function. But it really, there's a robust process for KYC and AML that already exists for other assets. And we would look to modify that and deploy that.
Well, just in the interest of time, I know we did not get to everyone's questions, and I do apologize for that, but I do want to thank Nicole, Damanick. This was definitely a very interesting conversation, and I hope everyone enjoyed jumping on. Before we wrap up real quick, I just want to remind everyone that we do have some virtual programs coming up on the calendar, both next week and the week after for the Cutler Center. Next week, we are actually hosting a virtual screening and panel discussion for the film Savvy, which is an award-winning documentary film that investigates the historical, cultural, and societal norms around women and money. So the film questions why women often take a backseat to managing their money and reveals why it's increasingly critical for women to take the reins on their financial futures. So registrants, anyone who's interested, this is open to Babson community and the public. You'll receive a link to view the film 72 hours in advance of our panel discussion that's happening on Thursday, March 31st, with not only members of our Babson community who are very focused on financial literacy, but also the director of the film. So we're very excited about that. And then also coming up, one of the people that's actually featured in the film, we have, and we'll be doing a distinguished speaker series on Tuesday, April 5th with Sally Krawcheck, who is widely recognized as one of the most influential women in business. And so she is the CEO and co-founder of Elevest, one of the fastest growing digital investment platforms designed to help women earn more money, save more money, and invest to grow their money. So again, both of these events are available to our Babson community and to the public, and more information can be found on our website at babson.edu/Cutler Center. And again, I just want to thank everyone for joining us today, and a very special thank you to Nicole and Damanick for taking the time out of their busy schedules to jump online with us today. So thank you all very much, and I hope you enjoy the rest of your Thursday.
Thank you so much.